you obviously cite. What about game changer for investors? Now, put your words into action, right?
Yeah.
What do we need to do now as a result of this game-changing move?
Right. So this year has been about keeping it simple. You go big tech, you go maybe some private credit.
Yeah, go big or go home, right?
Exactly, and it was pretty big. But I think what you do in 2024, you broaden that out, and you look at pockets that have underperformed. So there's a few things on my radar in particular. One of the top performing sectors, at least when I left to go on the show, was real estate. If you look at REITs and home builders that Joe and I actually talked about last week, they're the top performing sectors because they've been most disadvantaged. They now have a relief rally. You look at bonds, actually, of all sorts of bonds, and what we know is yields fall leading into the first rate cut, and also rates fall after that as well. So if yields continue to fall, bonds can actually rally. And then, Scott, the other thing you and I talked about as well is unprofitable tech. And by the way, when I say unprofitable tech, I don't just mean tech. It could be biotech. It could be all sorts of young, unprofitable companies that have been left behind, and they're rallying hard now.
Okay, so there's this idea of whether, which, by the way, mega caps are mostly down today. NVIDIA is a modest winner, but everything else, whether it's Apple, Microsoft, Alphabet, Meta, Amazon, are all down. Whether mega caps are going to be an ATM, and some of that cash is going to go into these areas you're talking about.
Yeah.
Whether cash itself from money markets is going to just come in by itself into those other areas. I'm wondering what you think about that, because Goldman's Tony Pasquarello, who's pretty influential, and he runs their hedge fund client strategy over there, suggests that money doesn't necessarily have to come out of the mega caps to go into these other areas. It can, in fact, come out of money markets as yields come down. What do you think?
I think great note from Tony today, and I think he's spot on, because mega tech cap does not have to fall apart, because, first of all, if you look at valuations adjusted for growth in earnings, they're actually not that stretched when you look at that forward PE to growth multiple. And, if you have a solid economic environment and the Fed is pivoting, that is still a fine environment for big tech stocks. So I think money comes out of money markets, which pay 5.5% roughly today, but chances are they're not going to be able to pay that, let's say, 6 months down the road. So I think investors are starting to think about that. They're also looking back at this year. If you've parked a lot of your net worth in cash, you're probably regretting some of that right now. And so what are you going to go and do? You're going to go and see where the markets has underperformed, and you're going to go into the areas of weakness that we saw in 2023 using that money market cash.
I mean, people would agree with you, but not everybody agrees where the money's going to go. Like Jeffrey Gundlach was on with us yesterday right after Powell. He's not on board with that. Listen to what he said.
I think the logic that people have that money market bloat is going to go into the stock market is wrong. I think it's unlikely for investors to go from risk-free 6-month T-bills to the Magnificent Seven at massive PEs and all-time highs on the Dow Jones Industrials. I think they're much more likely to go from their mountain of cash in T-bills into bonds.
All right, that's provocative. What do you think?
Well, first of all, I think that's right, that cash is not going to go into some of the largest tech companies that outperform, because the ownership of those is something like, 29% of the market cap right now. It's just really pretty stretched. But I do think that investors have a unique opportunity, which is they have optionality to look at a number of different things. They don't have to only go into stocks, and they don't have to only go into tech. You could actually look across, and the opportunity set is so much broader now, across sectors and also across asset classes. Now, to Jeff's point, I think bonds are obviously worth a look, whether it's municipal bonds, whether it's investment-grade corporates, whether it's high yield. And I think you may be able to earn an equity-like return by taking some of that duration risk and some of that credit risk. So that's very compelling for investors. But do you put all of that eggs in that one bond basket? No, probably not. I think you do go shopping for areas of underperformance. And look, we're exiting this year on a pretty high optimism note, and I think that is going to carry over into January, and I think people are going to be kind of looking how to allocate their portfolios, and it's stocks, it's bonds, it's real estate debt, it's private credit. I mean, it's private equity. By the way, valuations have reset a lot in private equity and venture capital as well. So that's a unique opportunity set like we haven't had in 2 years.